Hi, welcome to the financial modeling case, which I call the four scenario financial model. So this case is basically looking at a company who wants to project their financial results, which is a common thing to do for financial models. And they have various scenarios. So they have four scenarios of revenue growth, which goes in line with cost of goods sold percentage, R&D percentage of revenue. So what this basically means is the revenues will grow 10%, and there will be a change in the cost of goods sold in relationship, a percentage change in relationship to the sales. And there's four scenarios of varying increasing revenue growth. And then there's four scenarios of compensation as far as various levels of compensation for the company. So I guess if the revenues go up and the profits go up, then there's some more compensation. Okay. So this is basically what we're going to do is we have these scenarios and we want to be able to include them in the financial model. So in the financial model, what we're going to do is financial model is mostly complete, except the income statement and balance sheet needs to be projected. So we have income statement and balance sheet from 2017 to 2019, but we want to project it out to 2025 to year 8. So we have 3 years of actual. And then we have 5 years, actually 6 years of projected. Now, in these boxes, the yellow boxes, this is where we're going to have the scenario, the first 4 scenarios in the blue, and then the green boxes will have the next 4 scenarios in the sort of orange color here. So I left some notes here, basically what to do. So one note here is use data validation for the Dropbox. So in here, I want to use data validation because this is going to be our toggle. When we change this, the scenarios will automatically update the income statement balance sheet. So first thing we want to do is data validation, and we find that on the data cell, and then we open up this little, it's like a check mark with a no sign, and we see data validation. Okay. So before I do that, I'm going to need a list. So I'm going to I'm going to call this scenario list. I spelled that wrong. So I'm just going to put it 1, 2, 3, 4, because I need a list. So going back to data validation, and I'm going to select list, and then I'm going to give the source. This is the source of the list, and hit OK. So now there's a little toggle here where I can change the scenarios. Okay, you see there's a little if statement set up here for the CAGR. So, okay, we're going to leave it on scenario 1. We also have it's going to put investment here. We do have this investment net present value internal rate of return that we want to have calculated based on the outcome of the scenarios. Okay, so use if statements. Let me just move this over. Use if statements to create 4 scenarios for this financial model. The goal of if statements connect the scenario box when cell K14 is changed between the trigger, will trigger the financial model. Use data validation. Okay, so we did that already. The scenario information is here, and we're going to calculate net present value on the free cash flow of row 100. Okay. All right, so here's the first scenario. So let me go back over here, and I need an if statement basically to say, if this is scenario 1, choose this for the revenue growth. So I'm going to have to use something called ifs. So let's move this over, and I'm going to, in this cell, I'm going to go to, so I want to do the ifs statement. And basically what I want to say is if cell 14 equals 1, if that is true, pick the revenue growth for scenario 1. All right, I'm just going to copy this. If K14 equals 2, then we want the revenue growth from scenario 2. If it equals 3, we want the revenue growth from scenario 3. Oops. From scenario 3. And if equals 4, we want to use it from 4. So let's hit OK, and there we go. So now we have this formula here. The problem is I can't drag it down because I need to put some absolutes. So the first thing I have to absolute is the data validation K14. So I'm going to put $ between for all the K14s. Okay, I'm going to hit enter. So now when I pull this down, we get 50%. And what we're showing here is, you can't see the titles over here. These are the same titles here. So that is correct. So I can pull this all the way down, but can I pull it all the way across? And we're going to double check the scenario here. And it appears to have worked. Okay. I'm going to open up these cells so I can match it 100%. So basically, look, if I change this to scenario 3, and you'll see scenario 3 will pop up here. And I'm just checking all the cells, and it's correct. So that's what we're going to do for that first one. Now we have the second scenario down here. Can I copy this formula from here to here? No, it doesn't work because it's pulling in this cell. So basically, I am on row, this is pulling from the wrong row. But I can modify the formula. So I'm going to, so I have the K14 equals 1. I want that to be Q49. So I just have to go in here and update all the cells. So the first one would be 49. If it's going to be 2, that's going to be 56. So I'm just going by this. And then we have 63. So I'm going to change this to 63. And then the last position, scenario 4, is going to be 70. So let's change that to 70. Okay, now I have to also want to clean up this formatting here. Okay, so let's see. I should be able to copy this down. And is that matching scenario 3? Yes. So let me just clean up the boxes here because it's copying the box formatting. Okay, so now I'm going to take this and copy it across. And I see that, yes, indeed, it's matching this. And if I were to go to up here and say scenario 4, and I can just double check. So all the scenarios I should go through, and I'm just double checking that it's indeed pulling in the right information for each scenario. And it is. Okay, and I'm going to move this, open this up one more percentage. Okay, so everything is, so now I've set up my if statements here. And I use this, when I do it, I use the function arguments box here. And I find that this helps. So the function argument box is a good way for me to put as many logical tests together at once, rather than longhand trying to type out the formula. That take unnecessary time to do that. Okay, so I've completed the first couple steps here. I can't do the net present value or internal rate of return as a capital budgeting process. And I'm going to, that is spelled wrong. So I'm going to, you know what I'm going to change this. I'm going to merge the cells here. I'm going to say capital budgeting scenario. Let's get some boxes here. Okay, so this is the capital budgeting scenario. Let's clean this up a little bit. Okay, now we're going to move down, and we have the scenarios, and they're working with our tool here for data validation. I'm going to leave it on scenario 1. And okay, so I'm going to go down to, now I'm going to go down, and we want to project these years, the revenue. So I'm going to go down, and I'm going to say, for year 2020 estimated, I'm going to take, you can use equals or plus. I'm going to take G74, and I'm going to multiply that by 1 plus H47. So this is H47. And then I'm going to close parentheses. And I have my sales revenue. Okay. Cost of goods sold. So I'm going to move down to cost of goods sold. And I'm going to take my revenue, and I'm going to multiply it by H48, which is this percentage of, okay. And then the gross profit is simply going to be our revenue minus our costs. This becomes our gross profit. Okay, moving down to research and development. So again, I'm going to take and you can, like I said, you can plus or equals the same thing here. I'm going to take the revenue, and I'm going to multiply it by the R&D percentage. And then here for selling and general administration expense, I'm going to take my revenue, because these are tied to, and this is very common, tied to a percentage of sales. So when we calculate these, they're tied to a percentage of the sales. And that's what the scenario model up here was saying, that these are the new percentages of revenue that's going to calculate cost of goods sold, R&D, and SG&A based on what we're estimating the sales to be. So the logic here is, if the sales go up, then the cost of goods sold have to go up, and that's pegged to a percentage of the sales. Okay. Now, to continue the financial model, we have our operating expenses. So I'm going to add to operating expenses. I'm going to add these two together to get my operating expenses. Depreciation and amortization. I'm going to take our row 53 times our sale. Let me start with our sales times, got to start the formula here. Our sales times 53, H53, which is going to be our percentage, our revenue and depreciation, amortization based on our sales. Now we have amortization and intangible. This is going to be, we're just going to pull this from H61. So you'll see it's calculated right here. So here is our amortization intangible. So this is just a number that's placed in the file. I'm not sure what the logic is behind it, but it's just stated. Okay, so stock-based compensation, we're going to get this from, we're going to take our sales again. Let's see, stock-based compensation. We're going to take our sales and we're going to multiply it by H52, which is our stock-based compensation percentage of revenue. So the idea is if we make more money in revenue, we're going to pay more in compensation in the form of stock, which just means we'll convert these dollars into shares of stock. Okay, operating income. So let's move down here to operating income. And what we're going to do here, let's see. So to get our operating income, I'm going to start with our, let's see, I'll start with the gross profits. I'm going to minus from that our operating expenses, minus our depreciation, amortization, and stock-based compensation. Okay, so interest expense, this is going to be, so interest expense, this has to come off of the loans we have. So this we're not going to calculate. I'm just going to give you this number, and we're going to assume that there's 0 interest expense and 0 other interest. So let's just put this format over here. And make this. Okay. Let's clean up the border on this, no border. And then we want to do border left. Okay, so we're just going to bring these zeros across. And these borders. This is the annoying part when you're copying things over. Just want a bottom border on that. And then border right. So this is basically one way of making this. Okay, so we leave those zeros, and then pre-tax income, we're going to calculate the pre-tax income, and this is going to be the sum of the operating incomes. So I could use this little auto sum function to calculate that. And I can just drag that across. We're going to drag it across later. Okay. Tax provision. So if we're going to calculate the tax provision, we're going to look at H56, which here's the effective tax rate. And we're going to multiply that by H90. So we're going to pay tax on our income. So interest income is that if we had money in a savings account, is basically what this is. And interest expense is if we had debt and we're paying interest on the debt. Okay, so let's look at our net income, which is going to be our pre-tax minus our tax. This is our net income. So earnings per share, we want to calculate our earnings per share. So we're going to take our net income and we're going to multiply that by we're going to, let's see here, how I'm going to do this. So I need to know the amount of, we have the diluted shares here. Let me just think about this for a second. Okay, so we are going to, we need the diluted shares. So the diluted shares, we're going to just copy that from the previous year, since we're not saying that we're adding or subtracting any shares to this. So basically, if I take the, okay, so this is, we have to remember that this is going to be in the thousands. So units, this is going to be in the thousands. So basically we truncated the money here by 3 zeros. So we can't really calculate earnings per share until we take our earnings and we have to multiply it by the units, because it's dollars in the millions, except share amounts where the dollars and shares are counted in thousands. So we can take this formula and now we should be able to divide by our income. Cancel. All right, that's not the result I'm looking for. Let me see what I did here. Okay, I don't know why I did 93. I want to do the shares. 6. Right, now that makes sense. So what we're basically doing here is I'm taking the net income, I'm multiplying it by 1,000, because this is really represent 13 million, but it's common for when you're working with financial statements to truncate 3 zeros and put everything in the thousands. So this is really 13 million, but we display it as 13,000 to save space in the spreadsheet. So if we're trying to convert to earnings per share, we have to get that units or the $1,000 back in, and that's how I would calculate the units. So this units here is based off of this units here, which is a named range. That's why you see units here. This has been named. So that's why in the formula, you see units. Okay. Now let's calculate the EBIT. So it's going to be H86 minus H84. So H86 is the operating income minus H84, which is the stock-based compensation. And that's how we get earnings before interest and tax. So we're not subtracting the interest, and we're only subtracting the stock-based compensation, because that is not, we don't want that in the earnings. Actually, now I'm thinking about it, we want to add that. That's my mistake. So let me take H86 and I want to add back in the stock-based compensation. Okay, earnings before interest and tax. Okay, because this operating earnings we took out those stock-based compensation. Okay, so earnings before this EBITDA, earnings before interest, tax, depreciation, and amortization, what we want to do here is we want to start with our operating income. Then we want to add to it our stock-based compensation. Then we want to add our depreciation. Oops, let me just move this out. That's our stock-based compensation. Then we want to add our depreciation plus our amortization. So if we added these four things together, we're going to get our EBITDA. Okay, now we want to do our leverage cash flow, leverage free cash flow. So here we're going to take H 165 plus H 171. So we're going to take H 65, which is our operating cash flow, and then we're going to add to that H 171, which is our capital expenditures. Okay. Now, this down here, the cash flow statement will change once we put in the balance sheet. So this number will update because I already, in order to make things a little bit easier in this case, I've updated the, I've left in the formulas in the calculations for the cash flow statement. I'm only focusing on completing the income statement and balance sheet here. Okay. So book value per share. So we'll go to calculate book value per share. This is going to be, again, we're going to go down to we're going to have to go back and calculate this after we calculate the balance sheet, because we can't do the book value per share until the balance sheet income statement. Income statement's done, but the balance sheet. So we'll come back to this. I'll leave this as bright yellow so I know to come back to it. Let's move down to the income statement. So we want to calculate our cash and cash equivalents. So we're going to go to H186 down here, which is our cash and equivalents. So we're going to pull this from the cash flow. Then we're going to do our short-term securities. So short-term securities, we're going to go G108. And we're going to minus H168. And we're going to minus H169. So the proceeds, sale of securities, proceeds from maturities and sales. And this is going to give us our short-term securities, our accounts receivable. This is going to be, this is part of one of the formulas before. So we're going to take H58, accounts receivable percentage of revenue, and we're going to multiply it by here we're going to multiply this by the sales. Okay. Now we're going to do inventory. Okay, so we're going to take for inventory, we're going to take H60, just down here, and we're going to multiply it by H75. H75 is up this way. Cost of goods sold, okay. It should be H60, I had 160. Okay. Then we're going to do our deferred taxes. And our deferred taxes are going to be G111 minus H155. So we're going to go to the previous column, minus H155. And that's 0. So we just get a 4. And then total current assets is going to be G112. So we're just going to bring that over. No other current assets. Now we're going to calculate total current assets, which should just be the sum of this column. Okay, so let's move down to long-term liabilities. And for the first one, long-term liabilities, we're going to take G116. And we're going to minus H170. And then we're going to minus H173. Okay. So property, plant, and equipment, we're going to take start with G the previous year. We're going to minus H171. Oops. I'm going to minus H152. And then we're going to minus H156. Now goodwill, we're just going to copy it over from last year and change in intangible assets. We're going to take G119 minus H153 minus H172. Other assets, we're just going to bring over this number from the previous year. And then we're going to do the sum of this column to get the total assets. Now with the total assets, we have to add to it. This isn't total long-term assets. We're going to total assets. We have to also add to this current assets. Okay, accounts payable. We're going to take 863 times 875. 863 times 875. And then we're going to do for accrued expenses, we're going to take 865 times H80. Okay, so what we have here are our assumptions. These are our assumptions here. So this whole area is our assumptions. So our assumptions these are only the ones changing by scenario. In the other scenarios, we're keeping the other projections, assumptions, the static. So these are not going to change. Okay, let's keep going down. Calculate deferred revenue. We're going to do H66 plus times H74. H66 times H74. Okay, so then get the total, auto sum to get the total current assets. All right, so now we're going to move down here to deferred liabilities. So we're going to do, for deferred liabilities, H67 times H74. And then long-term debt, that is just going to be, we're not building a scenario where we're taking on more debt, so we're just going to bring the long-term debt in at 0. And then other liabilities, again, we're going to just copy from the previous column because we don't have any, there's really no, let's see, we have deferred revenue and long-term debt, and then other long-term liabilities. There's no projection for other long-term liabilities. So we're going to leave that to be, we're just going to have to carry that forward. Okay. And this is total liability, so we have to add to this our current liabilities to get our total liabilities. Okay. Now, common stock, this is just going to come from G137. Bring that over. And then we're looking at the additional capital and paid in capital. We're going to take G138. And we're going to add H177 and H154. So we'll just go H154 plus H177. Okay. Now we're moving on to our treasury stock. And again, what we're going to do here for our treasury stock, we're going to say, take last year's and add to it H178. And we have 0 there. For retained earnings, we're going to calculate this as G140, last year's retained earnings. We're going to add to this H93. Back this way. Plus H179. All right, so that's our retained earnings. And then, actually, we should subtract, not add the dividends. That's my mistake. Sorry. Accumulated other comprehensive income. And again, we're just going to pull this from the previous year because there's no change in that. So we're going to sum this for total shareholder equity. And then we want to calculate total liability and shareholder equity. So we're going to do plus total liability. So we're adding the total liability to the equity. And we have, on the check here, we have an imbalance. So that means the balance sheet doesn't balance. So let's go back up and we'll look at the balance sheet here. Okay, long-term liability. This is actually, so this should be 171. No, this should be not, this should be purchases of LT, long-term investments. So this should be 170. So that's a little boo-boo there. 5, 16, 47, 63. Okay, now we have it checks and balances. So that was one little mistake I made there. Now what we can do is I can work on this. Now that I finished the balance sheet, I can work on that cell, which is going to be the book value per share. So here I'm going to start with H121. I'm going to minus H118. I'm going to minus H119. I'm going to minus H134. Okay. Now, this is book value per share, so I'm going to have to divide by the amount of outstanding shares. So I'm going to multiply it by, first let me put parentheses around this, because I want to multiply all of this times 1,000, which are the units. And then I want to divide it by the diluted shares. Okay, so this becomes our, I'm just going to go here, and this is our, okay. So now that I have all this filled in here, I'm going to take this column, take all these, oh, you know what, I have to be careful, I don't want to break that year. So let me just start here. I'm going to start here. I'm going to bring this over so I can just drag this over. So this cell didn't work because I have to, units are fine. I think that should be fine. But when I pull this over, it was elevating this amount. I don't want it to elevate that. Okay. Okay, this is not calculating because I have to still populate down here. So I'm going to scroll down here. This I can take a big, I can just bring this over. All right, and all my balances are still 0. That means the balance sheet check. Very important that assets equal liability and shareholders' equity. And now I have all of my leverage-free cash flows in here, and I have my book value per shares. Okay, so now the financial model is complete. Down here, I already completed the cash flow statement, so I'm going to go up top now, and I need to complete the capital budgeting aspect of this financial model. So the net present value, I'm going to use our net present value formula. Go net present value, and the rate is going to be the interest rate. So I'm going to use this interest rate up here, and then the values, I'm going to scroll down to the leverage cash flow, and that's what I'm going to discount. So I'm going to start with the year 1 and bring it all the way through and hit OK. But this is not going to be our net present value because I have to subtract the initial investment. Okay. Now for internal rate of return, this formula is a little bit easier. So internal rate of return, I'm going to go internal rate of return. And this, I just have to select the values, all the values from year 0, the investment, all the way to the end. Very simple. Okay, so I get a percentage return. So so now I can check the scenarios. Scenario 1, I get 152,806 in net present value. So that means that's the present value of all the cash flows. And then the rate of return on this project would be 21%. So if I switch it to project 2, we get 179 and 25% return. So that is scenario 1 is better than scenario 2, and then scenario 3 is higher than scenario 2 and 4, which this makes sense because we've been moving up the sales. So these different scenarios have different net present value and internal rate of return based on the level of sales. Okay. Okay, now that the Excel work is done on the basic 4-scenario model, let's look at a way that if you were, say, working for a company and you wanted to do an executive summary and a dashboard for this case, what it could look like. So here I have a dashboard which has these sliders on them where you can select one or all 4 splicers, I mean. So you can select one scenario, see the net present value, internal rate of return, or select all the scenarios at once and create these dynamic charts. Same thing for leveraged cash flow per year, percentage, you see. So each of these charts have the percentage of total assets. So you can switch between the different scenarios here, or include all the scenarios, which the chart's a little best one at a time. And then we have the revenue growth versus the CG&A of revenue. We have the revenues by scenario for each of the years. So you can toggle between the different scenarios, or you can add them together and get sort of like an average here. We have the percentage of total assets by asset class. So if we're going to break it out by asset class, and this is over here, we have it, you can do it by year. Kind of see the dynamic change in that. We have a tree map looking at total assets versus shareholder equity and liabilities. So that every year that should equal. So it's just a graphic representation. And you can really see the change in equity versus liability here, because so you see how the equity is growing over the years as you change these splicers. And for each of the scenarios, it will change as well. Okay, so here we also have the PE ratio versus leverage cash flow in the combo chart. So this is just an idea of, I mean, it's a little smaller, of a good dashboard you could put together to represent the facts in this case. And then as far as a written element so this would be the dashboard area, this would be an executive summary. Of course, I'm making this small so you can't copy it if this was something you had to do, but I'll describe it to you. You would create an introduction, and then for the financial analysis, you would talk about the relative facts of each of the scenarios. And then the recommendation would talk about the usefulness of the scenario models, some advantages and drawbacks of it. And then the spreadsheet is completed by coloring the tabs of the different work. And there's a couple chart scenarios here. And then, of course, setting the print ranges for all of the pages. And that would be how you professionally finish this financial model. Okay, thank you for your time. I hope you've had a good time following me on this, and I look forward to talking to you soon.